Lesson 26, the Vega of an option. What you will learn here, what the Vega is, and an in-depth study on the Vega. Vega is the power of fear. Implied volatility, whose effect on the price of an option is indicated by the so-called Vega, is undoubtedly the parameter with the greatest impact on option prices, together with residual life and moneyness. In fact, once the strike has been chosen, it remains fixed. Interest rates have a relatively minimal impact. Then, if there are no dividends, the option price behavior model is reduced to a three-variable model: time, spot price, and volatility. The calculation of the Vega is the same for calls and puts, so it assumes the same value for each pair of options. Knowing in depth the effects of the three variables aforementioned allows you to better manage any situation that arises. Nevertheless, volatility is certainly the most difficult parameter to manage because it is the one that can vary most suddenly and with greater violence than all the others. When there are short put positions open, for example, strong and sudden descents of the underlying scare particularly, since they are almost always accompanied by sudden peaks of implied volatility. The sum of the two effects can be disruptive and often leads to severe problems, not so much in terms of real losses, as much as potential losses, which make the margins explode and force them to exit losing positions in order not to incur in margin calls. However, particular attention must be paid to the short selling of calls on stocks, especially in the US market, where there are no suspensions due to excess increases. If in fact downwards a security can at most lose 100%, upwards it can multiply its price by several times. Situations like that can be devastating for short call positions. Here the Vega of a call or a put strike 22,000 points on the FTSE index in front of different values of the underlying, given a risk-free interest rate equal to 0.01%, 30 days residual life, 25% implied volatility, no dividends. Vega is a measure of how much the option price increases or decreases compared to 1 point more or less of implied volatility. At the money options, once again, are the more reactive, in the money or out of the money are the less reactive. But once again, how do the shape of this chart change according to the different initial conditions? This is what we're going to see now. Vega of a call in respect with the implied volatility. Once again, also this could seem a contradiction in term, the effect of volatility against volatility, but it is not absurd. What happens to the chart of the Vega in respect with the volatility of an option, call or put, strike 22,000 points, FTSE index, interest rate 0.01%, residual life 30 days, no dividend, implied volatility ranging between 10 and 30%. The lower the implied volatility, the more only at the money options react to changes in the implied volatility. The higher the initial implied volatility, the more all the options react to changes in the implied volatility. Vega of a call in respect with time to expiration. Chart Vega versus residual life of a call or put option strike 22,000 on the FTSE index, interest rate 0.01%, residual life ranging between 5 and 365 days, no dividends, implied volatility 25%. This is what happens with an annual maturity, this is what happens with a quarter maturity, this is what happens with a monthly maturity, this is what happens with a weekly maturity, 5, 30, 120, 365 days. The longer the life of the option, the higher the reactivity of all the options to changes in implied volatility. And this concludes the part about Vega. Thank you for your attention.